I hear you on that. Well, I'm not gonna wait. I'm sure people are gonna be popping onto this call as we get started. I'm just gonna roll with you four for now, or five. Yeah, four. Um, but there's we have limited participants right now as of now. So before I jump in, this will be a fairly long session. So before I jump in, do you guys have anything you want to ask me about anything regarding business acquisitions or any of your business acquisitions?
Yes, Rich. I
Go
always
ahead,
have a
man.
question.
Oh, no
I'm
worries.
looking at a deal where all the employees are within the elevator unions, and I just wanted to get your take on what are the pros and cons of employees being in the union because I haven't encountered one. From what I can see, the mechanics are making 155K,
Hmm.
and even the apprentice are making 100 to 120K. But that's not a problem because the gross profit margin is 60% year over year, every year. So that doesn't seem to be the problem because they are able to charge a lot and the customers are willing to pay for it. It's a residential elevator niche a company that I'm looking at.
Uh-huh.
One thing on top of my head is you always wanted to structure your incentive compensation in a way that would incentivize your employees to do a better job, higher sales conversion rate and better customer service, and that ends up with a good Yelp or Google review, right? But seems to me the collective bargaining agreement would sort of handicap you in some way to structure your compensation that way, especially when you are already paying them that much. Like, how much room do you have to put incentive plans on top of the base?
Yeah.
So I just want to get your takes on the pros and cons.
Yeah. I'll say this without, yeah, I'll just say it this way. I probably, and I'll say it from the standpoint of my personal opinion, I probably would not pursue a union shop. Um, we can get into around. We can talk about the compensation incentives. Yeah. I mean, if you do pursue a union shop, you're correct in that there are going to be some issues with trying to provide, you know, compensation incentives, especially if you've got an outstanding employee. You're going to have an issue around collective bargaining. You're going to get, you're going to have to obviously deal with union quote unquote bosses. If one person wants it, they're going to want everyone to be able to get that same, incentive or benefit. And maybe everyone else isn't necessarily at that same level. Now, obviously, you could structure it in a way that they have to get to a certain level of production to get to the incentive, which kind of, I guess, objectivizes the um, the incentive in terms of you know people actually having to actually execute to get to it. But the problem with union shops, in my opinion, is that there are a lot of legalities and regulations around employing union workers that could ultimately cost a lot more that isn't necessarily being portrayed through the financials. And when I say that, not in terms of monetary, but I'm saying in terms of just employee morale issues, just the time you and your management team would need to take to negotiate new contracts once they come up. It's just I personally I personally am not a big fan of owning those types of businesses. I'm not against unions per se. I just don't want to be an owner of a business that actually employs union workers because I want to be able to kind of pick out those exceptional workers that I think might be that I may want to over incentivize them. And now when I say over incentivize, I mean higher than what the normal incentivization plan might look like, that I want to keep long term. And it's, you get into a situation too with union workers, it's hard to fire them without, some sort of action on the part of the union. I mean, it's just, to me, it just creates whole lot of headaches down the road that you don't necessarily, or that I wouldn't necessarily want to deal with. Now, that's my personal opinion. You maybe talk to Quinn or Daniel, and they have a completely different opinion around unions. I would probably say Quinn probably is on the same board with me as far as unions go, at least owning a business and dealing with unions. Daniel, I'm pretty sure Daniel's probably on the same page, but I'm not. I can't say for 100% with 100% surety that he is. But maybe you reach out to him, ask him that question and get his perspective. But that's my personal perspective from it.
Okay, thank you. I do see, yeah, there's definitely, with the union being there, it handicaps you a lot as an owner, what you can do, what you cannot do. But at the same time, I see some pros in there in terms of the stability. The employee tenure is just incredible. They don't leave. They've been there forever, and
Or you can't fire
most of the mechanics been there. Yeah. Yeah.
That's the flip side of that.
That is for sure. And so I would like to get, because I'm in this program with Acquira to buy a business with Acquira,
Yep.
systemize it with Acquira. I'm in this ecosystem, and ultimately, I want you guys to be on board and have a warrant on the business and sell the business to you. So if it's a black flag for you guys, then I would just not looking at this deal any further. Wish I would have talked to you 20 hours earlier before I jot down 50 questions, but that's that's a process I'm going. This is the first CIM I'm reviewing, and I'm going to page by page, stop everywhere, just write down all the questions as I go along. It's a good exercise anyway.
Yep. That's how you should do it.
But I guess at this point, I would like to know the acquirer's position on this, because if that's a black flag, then I would know going forward whenever I see, a union, then I just don't spend any time on that deal any further.
Yeah, I don't know that it's a complete black flag. I'm telling you, I wonder why are okay. No, people are asking to get in, and I'm selecting them. I'm letting them in, but it doesn't seem like okay. They're showing up. All right. It's may not be. I mean, it's a case by case basis. I mean, we'll take for instance, for you, obviously you're in my cohort in the accelerator, so send me the information on the business. We'll take a look at it. I'll take a look at it first, and then talk to Hayden and Quinn and those guys about it. And I won't say it's a complete red flag in terms of us just really getting cold on the business. But, I would like to talk to them to get their perspective on it. And I would, at the point where you would like to engage and move forward on the business, for instance, just to say we figure out that, hey, it's not a complete red flag for us. Let's move forward with it and see what we have. At some point, you're gonna want to engage a labor attorney to review, the labor agreement with the union, because ultimately that can make or break your business. Obviously, you have the other due diligence that we can kind of help with, and then coordinate the other stuff, but that particular piece is so specialized that a labor attorney would definitely be worth the cost to bring in to review any labor contracts, any potential labor issues that may crop up, post sale. And maybe there's something on the horizon that you don't know about, which is maybe why this business owner is trying to sell the business. But maybe there isn't. But you want to make sure you look into that thoroughly before you commit to moving forward on it. Before any monies are exchanged, let's just say in an LOI and they want a deposit or anything like that.
For sure. Thank you. I will do that once we go offline. As a
Okay.
follow-up questions, right? So even if you buy a business that's not currently unionized,
Hmm.
there is also a possibility that they could
Oh yeah.
unionize, right? And how do you
Yeah.
mitigate that? How do you factor it in as a business buyer?
Yeah, I mean that could happen with any business. But the chances of it happening. I mean, unions have been declining in this country for a lot of years, so I mean the chances of it happening are fairly low. Although we've had the issue recently with Amazon workers trying to unionize. Um, I think it ultimately was defeated, but I'm not sure. I can't remember. Um, but those are different company strategies that you could employ to either not allow them to unionize or to allow them to unionize. But at that point, you have a little bit more leverage in terms of what you can do, just because you're the owner of the business. So whether you allow it or not is up to you. You can decide, and they can move on and go to some other company and say, look, we're not allowing unions or what have you. And obviously they have a right to file a lawsuit if there's a big enough cohort of employees to do that. But the types of the shops that we're talking about buying, I mean, you're gonna have what, 5, 6, 7 people, in the beginning of that process. You're probably not gonna have a situation where you're looking at a union. I can't say that, unionization issue. I mean, your techs, let's just say if you're buying a home service business, most likely they're making good money anyway, so why rock the boat? If they're professional, techs, and they've got certifications or what have you, they're going to get rewarded for those certifications. So I don't think it's necessarily an issue you're going to have to deal with unless you're buying, maybe if you're buying like warehouses or something like that, or you're buying businesses which that doesn't have a level of certified type workers, or professional or licensed workers. Something that's more like if you're buying a cab company, maybe your cabbies are going to unionize, or like I said, a warehouse, maybe your warehouse workers will want to unionize to get higher wages. Or buying a grocery store, maybe your grocery workers want to use, but it's going to be those types of situations as opposed to a plumbing company or a roofing company, or you HVAC companies. Most of these guys are professionals, at least the ones that run the crews. So I just don't see that it would become an issue. Now, that being said, what type of business are you looking at? Elevator company?
It's a residential elevator company. They do minimal commercial, so they mostly with people with high-end homes or elderly people, people getting older, they need an elevator or a stair lift.
Okay.
That's all they do. They do service and new installation. I like it in the sense that elevator has to be serviced no matter what on a regular basis, right? It's not one of
Yeah.
those things you can wait until it breaks, then you call for a repair service because it's dangerous.
Yeah.
And with the new installation, right, that you obviously have a new construction risk. However, it's rich people are less affected by recession, first of all. And second is if it's in the case where elderly people need, they have mobility issue, it's a necessity. It's not a discretionary spending. So in that
Yeah.
sense, both the service and new installation component, I see it being sort of recession resistant. Not as resistant as plumbing, but I like enough of it
Okay.
where I, care enough to take a deeper look.
Okay. Yeah. And so these are the mechanics then that are unionized or what have you. Yeah. Well, mechanics
Yeah, and
unions.
it's
I mean,
through a
that's
local chapter, so it's not just the 11 of them unionized. It's
yeah.
through a local
Yeah. It's a local
chapter.
chapter of a
Yeah,
mechanics union. Yeah, I get it. I get it.
yeah,
Yeah. Yeah. So I mean, those are some of the cons around that. Obviously, like you said, there's some pros around stability of mechanics and what have you. But I mean, I think that's going to be a case by case basis. Yeah. And why don't you send me the business? Let me take a look at it, and I'll talk to these guys internally about kind of where we are with that, in terms of the union issue. Um, and I'll get back to you, and we can, honestly, you can reach out to me, schedule a call any point in time, since you are one of my cohort guys. So, but yeah, I'll get back to you. shortly.
Okay. Thank you. Now that I get a green light from you to book your calendar, I won't be shy.
All right. All right, Baron. All right. Anyone else got any questions before we get started on our most interesting topic that we are going to revisit? No, no questions. All right. Well, let's jump into. I think we'll use up most of the time for this particular topic. I'm going to share my screen here. Okay, so I wanted to, and this, I wanted to kind of revisit this topic because it came up with another um, AE who was buying. Actually, they were buying a plumbing business, but it was a. They wanted me to take a look at it, but it was a more. They do more commercial than residential, and so the purchase price on the business that this particular AE was looking at was fairly significant. But what it was an asset. It was an asset purchase, first of all. But one of the issues that cropped up during the review of this business was because the seller was walking away with all the cash, and they were taking the debts with them as well as the accounts receivable and what have you. One of the issues that we encountered was that the business had significant expenses that were going to be due to be paid, post acquisition, but the seller was walking away with, basically all the working capital that would help pay those expenses that we knew were going to come due. So they weren't listed necessarily on the balance sheet at that point in time. We just knew that on average the business was probably running about, if I remember correctly, about $80,000 per month in expenses. But yet there was no cash that would be coming in at that point to cover those expenses because part of the agreement with the seller was to allow them to take all the working capital. Um, and he had actually engaged with this person and signed off on a deal before he even met with me. So I kind of beat him with a stick after I found out kind of the deal that he negotiated with the seller. So that being said, I kind of wanted to revisit this topic with you guys so that you guys don't make the same mistake. I talked about working capital with the group probably about, I don't know, maybe a couple months back, and I think it was more of a quantitative driven discussion about how to do it, why it was kind of important, but we jumped around fairly quickly. And my assumption was that everyone understood what working capital is, or how to calculate it, kind of the importance of it. And I think I got the sense that, I confused a number of people based on my assumptions that I should not have assumed, as far as their kind of advanced knowledge of kind of what working capital is and why it's important. So I kind of wanted to go back to this topic and kind of walk through it on a more simplified basis. Um, and I want you guys to get a feel for some things to look for during your acquisition process as far as thinking through what could potentially be working capital issues, which should be factored into the price you're willing to pay on the business, which is where it's most important. Okay. Um, so I kind of want to go back through that. Some of the concepts that I'm going to relate to are more appropriate. Let's just say you're buying a business for more than $5 million. it's going to be probably more appropriate from that standpoint than a business that you're buying for less than 5 million. And there's no hard demarcation there, but it just tends when you're buying a business at about $5 million, you're really typically looking at EBITDA. You're valuing the business based on EBITDA, and the business is usually doing probably about $1 million in EBITDA slash cash flow. Probably have some sort of it's probably a more sophisticated business versus the businesses that are less than 5 million. They tend to be more based on seller discretionary earnings. They're not as sophisticated in terms of the systems that they've employed. They probably don't have management teams in place. So sometimes the accounting is a little bit funky with businesses below that level. So sometimes some of the working capital assumptions that you build into kind of pricing the business or willing to pay, when you're looking at purchasing the business, you kind of have to be a little bit more fluid on a business at less than 5 million in revenue or purchase price versus a business that's going to be more, that's higher than that at that point. So I'll kind of clue you guys in as to what may be more applicable than others. But I think most of the concepts we're going to talk about at least should have you consider items when you're in negotiations with the seller. Maybe you don't formally include it as part of the purchase price, but it's something to think about in terms of your negotiation in your mind, and kind of maybe in terms of a narrative when you're dealing with the seller, can kind of give them that person some insight into your thoughts. Hey, I may want to pay less for this business because X, Y, Z. So that's kind of where I'm coming from with this presentation. I'm going to kind of try to keep it not necessarily at a very high level, kind of at a medium level. So we'll talk about more detail, but I want to keep it for the most part at a high level and kind of drill down on areas that are important to focus on at a detail level. So that being said, let's kind of jump into the topic a little bit more here. So working capital, okay. What is it? Obviously, it's the capital needed to cover the daily expenses of the business after purchase. It's the assets, essentially. It's the current assets minus the current liabilities is the standard definition. But it's the capital you need to operate the business on a daily basis. But it's basically the assets you can quickly liquidate to cover any of those current expenses. And then that net effect after all those expenses are covered, that cash that's left in the bank is kind of the net working capital, i.e. the money that you can use or take out of the business. Obviously, you don't want to take out your working capital. If you can kind of use that to pay down any debt, long-term debt, thereafter, that's fine. It's business it's excess capital beyond those current liabilities or expenses that you need to pay that are sitting in your bank account. Okay. Sometimes in a purchase, in a business acquisition, it's included explicitly in the LOI that there's a certain amount of of capital you expect, or net working capital you expect in the business post acquisition. And I'll get to kind of how that works. Sometimes it's not included. Most times in a small business, you don't explicitly include it in what's called a working capital peg within the LOI. It just depends on kind of the value of the business, what you can negotiate with the seller. There's a lot that goes into it. So sometimes it's included, sometimes it's not. You're going to need it, whether it is included or not, within the business. And sometimes the seller will supply the working capital or leave enough in the business for you to operate the business. Most times they won't. And your lender will supply it to you. But it's important that you understand exactly how much is needed, because sometimes a lender may come back and say you only need a certain amount, but you need more than that. You calculate that you might need more than that just so that the business isn't running on, skimming by. And so there may be a situation for you to be able to go back and negotiate with the seller to get an additional cushion built in there. Okay. Some of the key considerations when you're calculating it, and we'll kind of talk about the calculations. Okay. All right. A detailed review of balances for expected and recurring expenses. Um, Now, what that means is it might be possible that some items under your accounts payable may no longer be operational or may not be relevant as you go through this analysis. And then you can actually remove those from your working capital calculation. Okay. But when I say you need to analyze what's in your balances, I'm mostly talking about, most of these businesses are not going to be businesses that you guys are buying that are going to be selling to other businesses. Sometimes you're going to get a B2B opportunity, okay, where you're going to have accounts receivable from that standpoint, okay. But you know what the accounts receivable are. You know your customers. You know what those balances are. When I say you want to examine the balances in detail, what I mean is the expenses and the expenses that are running through accounts payable. So you want to look at those kind of on a monthly basis for the last 12 months and figure out what are those recurring expenses that are coming through that accounts payable balance. Okay. Sometimes you may see a one-off that you may not ever have to pay again. Sometimes there are some that are in there once every 6 months or so. Maybe it's like insurance payments or what have you. But you want to analyze those balances in details because they're going to be important in terms of the calculation of the working capital that you need. Okay. Now there's some other expenses that come into play beyond that, beyond the accounts payable, that may not actually run through accounts payable. So you'll have payroll expenses that you're paying out probably once a month or once every or twice a month. You're gonna want to, know what those are. And there's also gonna probably be a lot of times small businesses have automatic deductions coming out of their bank accounts that could be material, meaning significant. Okay, you want to understand what those expenses are as well, because those expenses have to be paid on a monthly or semi-monthly or every 6 months or what have you. They have to be paid, so you need to understand and factor those into your working capital calculation. Okay, and part of that is adjusting for any omissions and errors within those balances. So you'll be able to. What I say that I mean is you need to make sure that you have captured all of those expenses in one way or another, whether they're running through AP or they're cash transactions, or they're just running through the P&L and not running through AP. But you want to make sure you account for anything that's not showing there. So if an owner is doing a lot of cash expenses and not recording them on their books, okay, you're going to need to account for those as well. That's all part of your working capital. Now, working capital, again, may affect valuation and purchase price. The rationale behind that is that the valuation of the company is based on its revenue and its EBITDA or seller discretionary earnings, okay? So working capital is necessary to actually generate the revenue and the profits of the business. So it's inherent in the valuation of the business. Okay. Um, if not understanding kind of what that number looks like, okay, you may be overpaying for a business in essence. And so you really need to be able to separate and find out how much it actually costs you to buy this, well, how much you're actually purchasing the business for, but what's that further investment you need to make into working capital to continue the business revenue growth or generating revenues for the business and the profits that go along with that. All right. Okay. So that's kind of at a high level from a theoretical standpoint, kind of why it's important to understand it. Working capital and asset sales calculate a little bit differently than a working capital in a stock sale, or so an asset buy for you or a stock buy for you. Okay, most of your time you're going to buy these businesses, and I would advise you in all cases, very few cases would I consider doing a stock purchase on a small business. The reason being, on a stock purchase, you're inherently going to inherit some potential liabilities that may be a little bit larger than you thought they were. And yes, you're going to be taking the cash with it, but at the same time, there's some opportunities out there for you to have some liabilities that may be a little bit larger than you think they are. So typically, when you buy these businesses, you're going to be buying these businesses. You're going to be buying the business's assets instead of the stock or the equity. Um, An asset sale is basically is a debt-free and cash-free transaction in which all the cash and debt remains with the seller. Okay. Um, so they get the cash, okay, but they're also going to theoretically take the debt that goes with that cash. Okay, so the assets that you're buying, and typically they're also going to take the receivables. So typically what you're buying are just the longer term assets of the business. Um, and you're buying that based on a multiple of the seller discretionary earnings. And the theory is that those assets, those long-term assets, are helping to generate that cash flow. Okay, so the working capital calculation for an asset sale is essentially the accounts receivable plus the inventory minus the accounts payable. Okay, that's the standard calculation. Okay, for figuring out what the working capital of the business is. This becomes important as we talk about how to actually calculate your working capital needs when you actually buy the business. But that's the base level calculation. Now, I'm assuming all you guys know what accounts receivable is. Who doesn't know what accounts receivable is? Uh, okay, everyone knows what that is, right? It's invoice revenue that has not come in. Okay, accounts payable, obviously amounts that have been billed to you, but you haven't paid them out. Okay, so that's the standard calculation. Now, let's relate this all back to kind of some of the businesses that you guys are looking at, which are more based on residential customers as opposed to business to business sales. So accounts receivables usually crop up when you have a business to business sale. Okay, typically businesses are going to pay in 30 days, 15, 30, 45 days, or whatever terms you have set. With residential customers, they're usually going to pay at point of sale or, quote unquote, cash on delivery. Okay. So at that point, they're paying their receivable. Theoretically, you have a receivable that's, 30 seconds long in essence. Okay. So the standard calculation for figuring out working capital doesn't necessarily apply to, let's just say, a home service business. Let's say you're an HVAC company, you're going out, you're servicing customers. They're either going to be paying you typically right there on the spot with cash or a credit card, or they're, for the most part, I mean, you could leave them a bill. Doesn't usually happen, but usually they're going to be paying within, a week or 2 weeks. Okay, so if there is a receivable, it's a very short-term receivable. So you need to adjust your calculation to account for that. Okay, so in essence, when we're looking at the working capital calculation for these types of home services businesses, I would also include the sales that are off your profit and loss statement, because those sales are being realized and captured and collected in the same month. Okay, they're just not being dragged out like an accounts receivable would be. Okay, so in essence, you're collecting their accounts receivable instantaneously. It never shows up on the balance sheet, but it's still an essential part of your working capital. Also, businesses have expenses they may not necessarily run through accounts payable, like we just talked about, such as payroll, auto deductions from your bank accounts, and you need to account for those. Okay, so that they're part of that calculation. So your for this particular calculation, you would substitute maybe your sales number for the accounts receivable. Okay, if you have inventory, if you're selling inventory, if you're an HVAC company and you're selling minor inventory, okay, you can include that as part of your inventory. And then your accounts payable is going to include not only your accounts payable, but any of those, your salaries and wages that you're paying out, plus all those cash expenses that are running through there. So that's essentially, then you can determine what the working capital looks like. Okay, so that's the calculation for a typical asset sale. Now, in a stock sale, it's a little bit different. And I want you guys, I know this is all kind of, I remember we're recording this, but I want you guys to kind of get the concepts here. And we'll talk through some, kind of how this all works together. But I have to lay it out for you in the beginning of the process. Stock sales. Okay, the buyer is purchasing I guess, they're purchasing the stock of the entire entity, so to speak. Okay, so instead of just buying the assets of the legal entity, you're buying the stock, you're buying the entity, which includes the cash and the liabilities of the company. Okay, so your working capital is effectively, the calculation for that is a little bit different, and it's more of the definition of working capital that most of you probably know. It's all your current assets and cash minus your liabilities. Okay, and the theory is obviously, since you're buying the stock of the company, a lot part of the valuation of that stock that goes in the valuation of that stock is the cash in the business, as well as the current assets and the current liabilities, basically the working capital of the business. Okay, now some of that may be, if they're not managing the business effectively, they may have excess working capital in the business that you have to adjust for, and allow them to take out that excess portion. Or if they're not investing enough in the business, it'll kind of show here. But so that's the standard definition. But again, you need consideration should be giving to, the fact that most of these businesses are going to be point of sale businesses where you're going to collect the cash up front, and then most of the material expenses you are going to be running through. Okay, the AP, you're going to have accrued expenses now, that you're accounting for, and you're going to have those cash expenses that you probably need to account for that are running through the P&L. Okay, if you guys ever need any help with kind of some of the stuff when we're looking at these businesses, that's what we're here for. And I know some of this may be a little kind of over your head, but I think most of you guys kind of understand where I'm going with this. So you're going to make the same adjustments as you would on an asset purchase, effectively. Okay. Now, all this being said, now we got through this whole part of this presentation thus far, talking about what working capital is and how to calculate it on an asset sale or a stock sale. Okay. There's a reason. Okay. And most of you guys are probably asking, well, why is this important anyway? Okay. Well, there's a reason for it, because from the standpoint of, we talked about a little bit earlier, working capital is necessary to operate the business and should effectively be part of the purchase price of the business. Okay. At least that's how I do every acquisition that I've made or been a part of. I always try to establish what that working capital baseline looks like. So most people go into buying a business and they look at the business and they're like, hey, here's the SDE, here are all the add back, or here are all the add backs, here's the SDE, and I'm willing to pay, let's just say, a 3 multiple on this SDE without even considering the working capital in the business that's needed in the business. Okay. So, and we'll kind of talk about this a little bit, but you're buying a business, just say you end up buying the business for $3 million, and you get a look at this, you end up calculating that the business still needs to operate on, let's just say $500,000 of working capital. Okay. Well, in effect, if you're buying the business for $3 million and it needs $500,000 of working capital in the business, that factor needs to be kind of factored into the pricing of the business. So if you're just buying it straight on a multiple, but yet that amount is needed, you might have to, theoretically, if your lender doesn't give you that full $500,000 line of credit, let's just say the lender says, no, we're not going to give you, let's just say the lender, we're going to be extreme here. The lender says 0. We're going to lend you the money to buy the business. You have to deal with your own working capital issues. Okay. Well, then, if that's the case, really, you should renegotiate that price with the seller to bring that price of that business down to $2.5 million, so that you can invest your $500,000 difference into the business as working capital. Okay. So just from that basic illustration, I want you guys to understand how important working capital can be to the business. Now, you're probably not going to have an extreme like that, but I just wanted to make the point that working capital is a part of the value of the business, whether it's inherent in that value based on the calculation, or whether it's something outside of the calculation that you're, outside of the value or the price that someone wants to sell the business for. You still need to figure out, okay, is that value being realized? Am I overpaying for the business? Should I be underpaying for it to account for that? Okay. So All that being said, typically when you're looking at these businesses, you're going to establish a working capital peg, which is the baseline working capital that the buyer and the seller agree to after financial due diligence is completed. So what that means is essentially when you're going through and you're doing your financial due diligence, you're going to establish these baseline amounts. You're going to look at what the working capital is typically for the business, and you're going to want to set a peg, which is basically a point in time where once that business, there's a cutoff period you set, once the business is actually sold, the business should have a minimum level of working capital in the business as it transitions. Okay, that's all what the peg is for. Okay, it basically means the amount that should be maintained by the seller on the balance sheet at the date of closing. Okay, so it's very important. Both the buying and selling parties have to agree on the amount of working capital and the formula used for the calculation. What you're going to find is that the seller is going to want to minimize the amount of working capital that's there. You may want to somewhat maximize it, but there's some games that are played based on kind of what the value of the business or what the pricing of the business is, as it stands initially. Okay. Both parties are going to negotiate to establish that common ground because a company's working capital can often fluctuate from month to month. So all that means essentially is they're going to want to set it at a certain level. You're going to want to set it at a certain level. Okay. You're going to want it at a certain level because it's going to make you feel a lot more comfortable that the business can continue to run as it is or grow. They're going to want it at a certain level because they're going to want to take as much cash out of the business as they can. Okay. Now, in the situation where working capital, and we'll talk about this in terms of the calculation, there's going to be situations where working capital, the company's growing. If you guys are buying, maybe this isn't as important in the home services business, but let's just say we'll use a tech company as an example. Let's just say there's an established tech company. They've got a plan and that company's growing rapidly. Well, their working capital needs are going to change from month to month and they're going to continue to grow. Okay. So then there's going to be a negotiation set around that. Okay. Well, if the working capital is growing, the working capital needs are growing, okay, for the business. Okay. The seller, obviously, that means the seller has a high growth opportunity. They're going to want to work more. They want more for the business. Okay? You're going to obviously want to limit that amount because you obviously realize you're going to need more capital in the business for it to keep growing. So there's a whole lot of rigmarole around this entire process, but I just want you guys to be thinking of it from that standpoint. But working capital is typically set on a cash-free, debt-free basis itself. So the seller is going to keep the cash and is responsible for any existing debt before the acquisition, and the business is delivered without that debt and cash, but it's still delivered with a sufficient amount of working capital. So some of this can be confusing in that when you're buying the business, the seller's getting the cash and they're taking the debt with it. Okay. They're also taking the accounts receivable. We talked about this. Okay. That's one aspect of it. Okay. But when you go at the certain period of time when you're actually going to close on the business, okay, the business still has to have working capital, even though they're taking the cash, the receivables, and the debt up until that point of time. The business is still going to incur expenses after that cutoff period. Okay. So that's where we're just getting into the point of establishing what that baseline looks like. Your employees are still going to be coming in to work, even at the time of the cutoff period of this transition date. Your employees are still going to be working. Okay. So you're going to be incurring wage costs. Okay. You're going to still be selling products or selling services. So there's going to be expenses related to that. Okay. And so those expenses and those wages, those expenses of operating the business are going to probably be hitting before you get your cash in from sales. Okay. So there's still some working capital that's going to be needed. Okay. Now, obviously, if it's set on a cash-free, debt-free basis, the benefit of this approach for the seller is that if the business increases its net working capital during that period after the cutoff, then a positive purchase price adjustment occurs in the reconciliation process. And the reconciliation process is just the time from the actual cutoff date to the time the business closes, meaning you close on the business. So there's a cutoff date established, but you're not usually going to close on the business for maybe 30 days after that cutoff period. Okay. Um, this can be particularly important in many cases when the working capital of a growing and profitable business may increase during maybe the 3 months covered by from the exclusivity period of an LOI to the actual close. Okay. If the business reduces net working capital but increases the increased net cash retained by the seller would effectively offset the negative price adjustment that you would make on the business. Okay. I'm not going to get into all of those specifics around how that works, but effectively, it's a benefit of both for both parties to establish this peg. Okay. Now, I want to get to kind of more or less how to actually do this because I think it'll become more plain to you or more clear to you. Okay. So let me kind of explain. We kind of talked about this. Without an agreement on working capital, you can imagine that all sorts of bad behavior can occur on an acquisition by a seller to take advantage once the terms have been negotiated. So if you don't set a peg, for instance, let's just say the seller wants, you have an agreement for the seller to take all the cash out of the business up until a certain point of time. Okay. Well, the seller can play with those numbers before you get to that close period or that cutoff period. The seller has an advantage of knowing exactly end-to-end information about his or her business. The seller could manipulate that working capital cash flow and pour more cash flow out of the business or cash out of the business than is warranted. So, for instance, I've seen a situation where prior to the closing of a deal, the seller aggressively went out and collected on outstanding receivables from their customers. And they offered them basically a discount to actually speed up the collection of that cash. Now, mind you, remember, it's based on, this peg is based on working capital, but we also have an agreement where the seller can take out cash, all that cash, before we get to that cutoff date. Okay. So they actually went out, they got the seller to actually accelerate their payments of those receivables. And then what they did, that wouldn't necessarily affect the working capital. Well, what they did was they actually defaulted on a lot of payments to vendors. So effectively, they drove up the working capital number because they weren't actually paying their vendors. Okay. And then what ended up happening is at that cutoff period, they basically swept all that before that cutoff period, they swept all that cash to their account as agreed to. And then essentially, when the business transitioned to the new owner, okay, the owner basically had a whole bunch of vendors that hadn't been paid. And I think it makes pretty clear why establishing kind of what that baseline working capital should look like at that cutoff period. They had to literally go out of their pocket to basically pay those vendors, which effectively increased the price of the business that they ultimately paid. Their lender didn't give them the line of credit for that. The lender thought that was a miss on their due diligence. And so the lender effectively said, no, that's not part of our working capital calculation that you needed to have in place as far as the line of credit goes. And so you guys are going to have to eat the cost of that. So they effectively paid more for that business than they thought they would because they allowed the seller to get away with not having this peg in place, which effectively left them holding the bag when it came to the vendors that the seller ultimately didn't pay because they were playing with the cash flow from that standpoint.
That should they have like where was our lawyer in this? And because like that's something I know our M&A lawyer would not allow at all.
Yeah. So okay. So this is good point. This is a situation where it was a small enough business where the buyer themselves, and I don't think this buyer had ever purchased the business before, and they wanted to save on the expense of having a lawyer review the LOI. And so they put together the LOI themselves, hoping to save a few bucks, and they didn't include this peg. And so by the time they signed it and the seller group had signed the LOI, they were already in a situation where it was too late. Okay.
But
They're,
yeah, they could have addressed that, right?
huh?
This could have been addressed in the asset purchase agreement, or in this case,
No, it
stock.
would have been, yeah, it would have been addressed in the LOI.
Well, I'm saying even if they didn't include that, they could still bring it up in the asset purchase agreement or the stock purchase agreement.
Well, it was asset purchase agreement.
Asset purchase, yeah. So, like,
Yeah.
that's something you can put in those terms, like, because not everything's going to be caught in the LOI. Like, there are things that are going to come up, and that's the point of having the asset purchase agreement based
Well,
on the LOI. But like, things will be added. That's just inevitable.
yeah. So in the asset purchase agreement, mind you, the asset purchase agreement will contain a lot of indemnifications and reps and warranties. So theoretically, through the reps and warranty section, um, their lawyer would have written it in a way that would have essentially captured and what I would call a
Yeah, no, I know what you mean because we have it within the first paragraph or second paragraph of any LOI we send to folks of like
yeah,
some
it would
thing. Like, that's just not.
yeah, it would have been considered, from an accounting or an audit, from the audit. When I was an auditor, we used to call them a search for unrecorded liabilities. So that would have actually been caught through a well-written reps and warranty section. Now, again, this guy, he didn't bring his attorneys in till late. I don't know if his attorneys addressed it through that. I'm assuming that they didn't address it even through the reps and warranties section because they ended up coming out of pocket for it. And if they did address it, maybe he went back later and effectively sued for that amount. But after the transaction closed, I was effectively out of it and really never dealt with that client again. But it kind of begs and it kind of gives you guys an idea of the importance of actually why that peg is important. You want to make sure that you set it so that in a way that you protect yourself and effectively protect and hedge in the purchase price of the business. Because like I said, effectively you're paying more for the business at some point, especially if your lender doesn't cover it. Now, real quick, so the 12-month formula. Okay, so what you want to do from the standpoint of figuring out what that number looks like from the PEG standpoint. And this PEG doesn't necessarily have to be written specifically into the LOI. You could use this more or less as side knowledge or what I call asymmetrical knowledge on your part to actually negotiate the purchase price of the business and basically use it from a narrative point of view. But the working capital is calculated by looking at kind of the receivables minus the AP plus the inventory on a monthly basis. Now, remember what we talked about earlier is that most of these businesses aren't going to be business to business situations, but if you have a business to business situation, that's the calculation. If you don't, you want to substitute those monthly sales numbers in there, and then you want to still capture those expenses that are running through AP and any of those non-AP type expenses. You want to make sure you capture those. So in essence, sometimes when you look at these businesses that are the home services businesses, you could simply look at, maybe the profit numbers. They're probably going to be close enough. The monthly profit numbers are probably going to be close enough to working capital. But again, the P&L numbers sometimes are not going to be reflective of that. You just want to make sure you're capturing AP and all those expenses. That all the expenses are going to run through the P&L. Okay, but sometimes there's a timing issue with AP. That can kind of throw it off, and you want to make sure you're not double booking or what have you. So, but in essence, you want to make sure you substitute sales for the accounts receivable. You want to make sure you capture all those expenses to see what that monthly working capital number looks like. Okay, you're going to calculate that over 12 months, and you're going to take the average of that month, and that average number is where you're going to start your negotiation as far as the working capital needed to be left into the business. Sometimes the seller will agree to that, whatever that number is. Sometimes they won't, and you will kind of negotiate the value up and down depending on that estimated calculation. As a seller, the seller is going to be prepared to include, or should be prepared to include, the calculation in the acquisition price. Most of them don't. Okay. So that's kind of, it's up to you to really figure out what that number looks like. Typically, how you're going to apply this is a simple formula from your side as far as valuation or purchase price that you're willing to pay. Typically, you take your SDE multiple, okay, and you'd apply and add that working capital adjustment to it. Okay, so whatever that number looks like on a monthly basis, you could say, hey, this is the working capital needed to be left into the business or in the business. So this is what I'm willing to pay you. This multiple or whatever, and whatever that number comes out to plus your working capital number. So whatever, if that working capital number is 500,000, you're paying 3 million for the business. Whatever, it's a working capital adjustment that's a positive number, meaning that there's business. And remember, this is the number that needs to be delivered at the cutoff period. Okay, this is the amount of working capital you expect to see on the balance sheet at the cutoff period. If that number is there, obviously $500,000 worth of working capital there, you're willing to pay for it. If it's less than what that agreed upon number is, then the purchase price is adjusted for overall. Now, I wouldn't explicitly tell a seller it's the SDE multiple, it's my SDE that I'm paying for plus the working capital adjustment number. I would just tell them, give them a flat number. So I'd say, I'm willing to pay you $4 million for this business. Okay. Now, since you're not going to necessarily include a PEG in a small business acquisition in your LOI, typically they're not. But if you're not going to do that, then and you tell the seller, I'm willing to pay you $4 million for this business, you know what that working capital number looks like. Okay, so if that business is delivered without any working capital, and you realize you need $500,000 in working capital, then you would go back to the seller and say, look, based on my analysis, we need $500,000 of working capital. Based on my analysis and my bank's analysis, I want $500,000 in working capital in the business, whether that's inventory, receivables, less your AP or whatever. They need to leave certain amount of capital there. If they're not willing to leave that in there, then you tell them, look, then I'm going to adjust my price downward by $500,000, and I'm going to pay you $3.5 million for this business based on what we needed to calculate. This becomes more of a moot point, but I would still use it as a negotiating point when your lender says, hey, I'm willing to put in, I'm willing to give you a $3.5 million loan plus a $500,000 line of credit. You've actually really got the $4 million covered there. I would still go back to the seller and say, look, I need working capital in the business. I'm willing to pay you $3.75 million for the business. So you can use it as a kind of an what I call off LOI negotiating tool if you want. I've used it that way in the past. But again, understanding what that working capital number looks like or needs to be is important for you, because your lender may not give it all to you based on their calculation of it. But from your perspective, from a cushion standpoint, you may want more of that. Okay. So calculating that on a monthly basis by looking at the last 12 months is very important from that standpoint. I'm going to finish this up by just kind of, we don't really have time to kind of get into some more specifics, but I'll say this. There's no textbook rule for working capital calculation. There's no rule book that decides how working capital is to be included in the deal. Okay. If it makes sense to include it when it's a small business going for, I'd say it makes sense to include it when it's a small business going for a multiple of SDE, just because, again, you need to understand exactly how much you need, and I would adjust my price based on some level of that, whether it's the whole amount or a small amount. It's based on what your lender is going to give you and a discounted amount above, on that, or what have you. Or maybe you don't even, you realize that the price you're paying is fair and that the business will generate enough capital on its own to support it. That's fine. As a buyer, you need to take into consideration, though, the size, value, and the SDE to decide whether you want to include that working capital in your offer or not. Like I just said, every deal is kind of independent of itself, of each other, from that standpoint. So you really, some businesses, if you're looking at a business that has a lot of inventory in it, obviously that's probably going to be inherent in the price. So it may not be as valuable or worthwhile to go through the working capital calculation, because there's already working capital theoretically included in the business, at least the asset part of that. Obviously, you'd have to see what that offsets, how much of that offsets the expenses that you need to pay. But each deal is independent. And calculating working capital is primarily kind of unregulated. Like I said, it may or may not be included. How you do it is up to you. But I'm giving you guys kind of a simple example of how to do it, just kind of looking at the last 12 months, taking an average and kind of working your way back from there. Again, but it's crucial that you guys look at it. Multiples on, the multiples are usually higher on we always talk about valuation on these businesses. When you get to about $1 million or $2 million in EBITDA, the valuations kind of go up. Okay, those types of businesses, you really want to make sure you understand the working capital because they're included in the valuation of the business ultimately. It's actually very implicit in that number. Below that, they're not included as usually included as part of the valuation, but you want to understand what impact that working capital has. The final thing I'll say to you guys, and I'll let you go from here. Obviously, as you kind of find a business and you need help on reviewing working capital, I think it becomes very clear if you want to sit down with me and I'll kind of walk you through the exercise of calculating exactly how much working capital a business might need. But I'll tell you, they provide some key business insights as far as understanding working capital. It's an important metric to determine the minimum cash flow needed to maintain the daily operations of the business. It represents the value of the total assets and liabilities held by the business that will be transferred to you as the buyer during the transaction. And then the working capital is ultimately used to calculate the free cash flow of the business, which is used to compute the intrinsic value of the business over a long-term basis as the business scales. So it's important. I think we overlook it a lot of times when we're just looking specifically at multiple in terms of valuation. Again, I want you guys just to understand kind of some things you want to consider when you're looking at these businesses. And I think the most important takeaway from this discussion should be, if I'm looking at this business and the business, I take over this business, let's say in X month, okay? If I'm looking at the performance of the business beyond that, can this business continue with zero working capital in the business to start with? Okay, really focus on that question. And like I said, if the business can grow itself through its expenses or fund itself through its expenses from day one, then this becomes less of an issue. If the business cannot, if you've got expenses that are going to hit right away and you don't have cash in the bank to cover those expenses, this becomes a major issue for you. Whether you have good cash that you're going to transfer in to cover that working capital in that first month or 2 months or 3 months, or the lender's going to lend you provide a line of credit to cover that working capital in the first 2 or 3 months. It's important that you understand kind of what that number is, because you can quickly find yourself in a hole that you can't get out of because you did not consider the working capital needs of the business in your initial analysis. So that's the major takeaway from this. How we calculate it, I'll definitely work with you guys on that on an individual basis as you bring businesses to us to look at. And I think as you start to look at this valuation, at these working capital numbers, please factor them, whether it's explicit or not. You don't have to tell the seller, but factor those numbers into your valuation. Why pay $4 million for a business if you know you're going to need $500,000 in working capital? And pay $3.5 million for it if it's your own cash, and then you've got $500,000 to roll into it, or the bank can lend you $500,000 for it. But anyway, be able to justify the valuation based on that working capital need and be able to relate that to the seller, because the seller is going to obviously only be concerned about, hey, I'm taking cash out of the business. This is the multiple I'm selling the business for, but they're not considering what happens next beyond the actual purchase price or the actual purchase and when it closes. So consider that. That's it from kind of a working capital standpoint. If you guys want kind of examples of how it actually works, maybe we can put together some spreadsheets so you guys actually see how this works. It may make a little bit more sense, but I wanted to kind of keep it more or less at a high level in terms of understanding why you need it, how to, kind of on a base level, how to calculate it, why it's important to think about it in terms of valuation, and why you should negotiate based on that working capital need in the business. Any questions we have before we jump off? Great. That means I didn't do a good job with this. All right. So next week we're actually going to have Brian Stroh, who handles post-acquisition integration, to talk to you guys about what happens after you acquire a business and how to actually go about scaling a business, creating more value, and creating some wealth for yourselves. I will see you guys next week.
Thanks, Rick.
Thank you guys.
Great. Thank you so much. Very nice training.
Yeah, I know it's a little kind of out there, but it's important to understand it.
It's very, very important. I really learned a lot today. Thank you so much.
Okay. Thank you, Gloria.
Bye.
Bye. See you, Andre.